No one enjoys writing a check out to the IRS or a state, especially when they've prepared the return, had a bunch withheld, and then find they owe a balance still. And on top of that, maybe adding insult to injury, there's underpayment penalties and interest. Let's talk through some examples so that you know now whether it's the end of the year and you can make an estimated tax payment, or you're at the beginning of the year and you can adjust your withholdings and target those out for what you want. How to avoid all of that. It's called safe harboring. And we're going to look at an example here, a couple examples of how we get to those numbers. It sounds really involved, but it's actually really easy. So looking at last year's return, they made $100,000 using really round numbers for ease of understanding. They made $100,000, their tax was $10,000. Out of their paychecks, this couple had $9,000 taken out. So at the end of the year, there was still, they were $1,000 short. They had a balance due. Normally you'd think, well, a balance due, I have until April. In some cases, yes. There's a couple rules to think about here. Number one, is the balance due or the amount outstanding over $1,000? In this case, it's not. So they met rule number one. No underpayment, no interest, because the amount due is not greater than $1,000. Second, this amount here that they had withheld throughout the year was 90% of what their tax balance was. 9 divided by 10 is 90. They had 90% of their taxes paid in throughout the year. So number one, less than $1,000 due. 2, they had 90% paid in. So now we fast forward to this year. We're going to show that they got a raise, maybe got a bump up in salary, a bonus at year end. They know their income went up. It's hard to do some things here. It's hard to know what their year end balance due is going to be. It's also hard to know what the tax is going to be. So it's to do that 90% of this, it's a moving target. So that's really hard. What they could do, so this is rule number 3 now, is safe harboring. Looking at what last year's tax was, and if they pay 100% of that, 100%, $10,000, they're going to be safe harbored, meaning there may still be a balance due, and they would have until they file their tax return to pay it, but there won't be any additional underpayment penalties or interest. So that's rule number 3. Rule number 4 here is now, what if their income increases and the IRS has this threshold? If it's over $150,000, rather than being 100%, it's now 110%. So here it was 100, here it's 110%. So rather than looking at this and paying exactly the same amount, they would have to pay in $11,000, 110% of last year's tax to avoid any underpayment penalties. So I just talked about a lot of things. Let's just go through the rules real quick. If your tax due is under $1,000 any year, no underpayment penalties or interest. If you pay 90% of the current year tax in payments, you avoid the underpayment penalties and interest. If you pay 100 to 110% based on your income levels, that's another way of avoiding interest and penalties. So you never like to pay taxes. Throwing in additional interest and penalties isn't fun. So how do you keep more? Because ultimately it's not how much you make, it's how much you keep. And our goal here is to help you keep as much as possible.